Okay. So in chapter 16, we went through and we created our income statement, our balance sheet, our statement of stockholders' equity, those basic financial statements that are so valuable to businesses and to investors, to determine the financial health of a business. And I talked about when we were doing the ratios, the vertical analysis, how we really use that to compare ourselves to other companies, to compare to other years, just to make sure that things are moving in the right direction and you're keeping up with your competitors and so forth. So that's kind of what we're looking at in chapter 17 now, is understanding the ratios a little bit more and understanding what's good and what's bad and which direction we should be moving and that kind of thing. Okay, so what we've got here is we've actually got 2 years worth of data. And really, if you look at a lot of financial statements, you may see that. So actually in your textbook at the end, we have Nike information, financial data from Nike, and what you'll see is you see every one of these has multiple years, right? There's the financial history. Here's statement of incomes, and it's all consolidated. It's not the big giant detailed list that we're creating, but you can see that you've got multiple years. Here's cash flows. Here's balance sheet over here on the left, right? But it's multiple years because you want to be able to compare from year to year. Okay, so with that, there's a lot of, calculating the numbers is easy, right? It's the analysis of the numbers that's hard. So it's going to take a little bit more thought, a little bit more reading, a little bit more understanding. You're going to want to study up the PowerPoints. You're going to want to read the chapters in the book so you really understand, because I'm taking you through some examples, but you can't just mimic my examples and get it right. You really have to understand the ratios and what's good and what's bad to be able to make a true analysis of the situations. Okay, so what we're going to look at first is the income statement, and this is all going to be vertical analysis at this point, and that means that we're comparing one number to another, okay, in a vertical layout, okay, one item to another. And for an income statement, we are always going to be looking at net sales. We're going to always be dividing by net sales. Okay, divide by net sales. All right, and basically these are going to be what we call profitability ratios, and this is our ability to earn a profit. Okay. So what they've done, a lot of these for us. Basically, all we're going to do is we're going to go in and we're going to fill in the blanks that we see here, and then we're going to do some analysis down here at the bottom. Okay. So again, everything divided by net sales. So for each year, cost of merchandise divided by net sales, right? This divided by that. Okay. And this is, cost of merchandise is really for a merchandise business, it's your largest cost of business. Sometimes, especially maybe in a service business, your payroll is the most expensive thing. I know in education, the most expensive thing is payroll, because you have so many teachers, right, that you're paying to teach. All right, so cost of merchandise. we do have in the instructions, and basically our instructions for the working together are to complete the vertical analysis, rounding to 1 decimal place. Okay, so we always want to make sure we're doing that, make sure we're rounding correctly. So 321,034.21 divided by 659,470.53 is going to be 48.7. Okay, and then over here it's going to be 47.0. And then gross profit divided by net sales, this is going to be 51.3 and 53.0. Now another name for this percentage right here is called gross margin or gross profit margin. Okay, so that's a number that a lot of people will look at. Just basically, what is your gross profit based on your sales? You know, how, and basically it's taking out the cost of your goods. We looked at this when we talked about this in detail when we were going through our setting up our income statements, right? Kind of where that's coming from, and before all of your other expenses, what's your profit? What is your profit based off of just your product, right? The cost of making the product versus what you're selling it for. Okay, so that's your gross margin. That's a good term to remember. Okay, and then we've got one down here that they want us to fill in. So this number again still divided by net sales. Okay, so that's going to be 14.0 and 14.8. Then our total operating expenses, again, divided by net sales, is 30.0 and 30.2. And then income from operations, again, divided by net sales, and that's 21.3 and 22.8. Okay, and that number, well, we're gonna, is down here, operating margin, basically, oh, you can't see that. Income from operations is basically your rate of return. So that's kind of another term to remember. I'm trying to figure out where I can write that down. Rate of return. Okay, so now you've got your gross profit taking out those daily expenses, right? Not worrying about some other revenue, not worrying about your income taxes just yet, right? What's your rate of return? What are you making off of your product, right? That's another percentage that people really want to look at, rate of return. Okay. All right. And then that's really all the percentages they want us to fill in. I didn't miss that, did I? Nope. Okay. All right, so then down here, this is the part of the analysis part. Okay, so they're going to want us to look at 3 different things. They've given us an acceptable range. Okay, and this is like a benchmark. You guys kind of understand benchmarks, right? It's a number set that they want us to meet or be close to. And these benchmarks can be set a couple of different ways. It could be a range that we've seen over the past 10 years in our business, and these have helped us be successful. So if we know we can keep our ratios within these ranges, we're going to be healthy. It could be industry standards. If you're a startup, or you're a new business, you may not know what's good or bad for your business just yet, but you can find industry standards, which is basically your competitors, right? What do their percentages look like? What do their margins look like? And if you base off percentages and not actual numbers, you can compare from business to business. Okay, small business to large business, medium business to large business, whatever the case may be. Okay, so that could be another place that these numbers have come from. And then, maybe those are built into your business plans. Maybe you have some financial people helping you, right, that understand the business as well, that kind of help you set this acceptable range. Okay, so now we're just going to pull some numbers down to, so we have them right here. So let's look at gross margin for the current year. That's the 51.3, and the previous year was 53. Okay, operating expenses, that's the 30 and the 30.2. Okay, and then operating margin, this is the income. It's kind of hard to know. It's the income from operations. Okay, so that's income from operations. Okay, so in case you need to know what that means. And that is 21.3 and 22.8. Okay, and again, that's also the rate of return. So I don't know why they have to give us so many different names for it, but they do. Okay. All right, so this is kind of what we're going to be looking at. Do we see a favorable trend, and are we within the target range? Okay, so easy enough to know, and we're only looking at current year, right? This is current year. Well, I guess that's not really current year. Within the range is current year. The trend is going to be over time. Okay, so that's current year. Within the range, that's easy enough. Is 51.3 within the range? Yes or no? Yes. Okay. Is 30 within the range? No. Is 21.3 within the range? No. Okay. Now let's look at the trends from one year to the next. So prior year to the current year. So we got to kind of work backwards here. So we went from 53% to 51.3%. Okay, so number one, think about its gross margin. Is it so you got to look at two things. Number one, is it in the range to start with, right? And are we moving back into the range? So even though this is going down, our gross margin is going down, and we'd really like it to go up, right? But it's getting us back into that range. Okay, and that's the range we want to be in. So yes, it's a favorable trend because we were out of range last year. Now we're back in range. Okay, so you've got to look at, is it going up and down? Is that good or bad? But this one's going down, which initially you might think is bad, but it's getting us back into our range, right? And it's kind of getting us back into the middle of our range. If it was jumping so far down that it was getting to the low end of our range, we might have to say, we better watch this trend because it could not be a favorable one, because if it jumps that much again in the next year, then we're going to be out of our range on the other end. So again, it's important to kind of read and understand everything in the book and everything in the PowerPoints and the video that I'm going to have hopefully going along with the PowerPoints to kind of talk about that. Okay? All right, so this one, prior year, it's going down. We were out of range. Prior year, we're still out of range, but we're